Imagine the following scene. A person works hard their entire life, wakes up early, faces traffic, meets schedules, makes sacrifices. One day they finally decide to treat themselves to a brand new car. That new car smell, impeccable seats, shining dashboard. The feeling is good, but it doesn't last long. The exact moment this car leaves the dealership, it's already worth less than it was worth minutes before. Without driving a single kilometer, part of the money simply disappears. It's as if you had torn up part of your salary, only silently. Warren Buffett has always been very clear about this. A car is not an investment. A car is a tool. It serves to take you from point A to point B, nothing more than that. Buffett, even being one of the richest men in the world, never felt the need to buy new cars all the time. He always preferred used vehicles, reliable and well-maintained. Not because he couldn't buy a new car, but because he understood the real cost of that decision. A new car brings more than installments. It brings more expensive insurance, more expensive maintenance, higher vehicle tax, and the constant pressure to maintain a standard. Meanwhile, a used car chosen with criteria does exactly the same job, takes you where you need to go. The difference is that it doesn't suck your income every month, doesn't trap you in long financing, and doesn't steal the money that could be working for you in investments. Buffett teaches something simple here. Wealth is not looking rich. There is a very common mistake that destroys the financial life of thousands of people, even those who earn well. This mistake begins the moment the bank says, "Your credit has been approved." Many people believe that if the bank approved that amount, then it's safe to take on that debt. But Warren Buffett teaches exactly the opposite. The bank approving doesn't mean you can pay comfortably. It only means that in their view, you can bear the risk. A house doesn't just bring the financing installment, it carries along a series of costs that almost no one calculates properly. Taxes, maintenance, renovations, larger bills, furniture, fees, and unexpected expenses. All of this consumes your income month after month, quietly, until the day you realize there's little or almost nothing left to invest. Buffett has always defended a simple and powerful idea. The house should serve your life, not control your life. When you buy something at the budget limit, any unexpected event becomes a big problem. A change in income, a medical expense, an investment opportunity. Everything becomes harder because the money is already committed. A house that fits comfortably in the budget brings something much more valuable than status, peace of mind. It allows you to live well today and at the same time build tomorrow. It allows you to invest consistently, seize opportunities, and grow without constant pressure. True financial security is not in living in the most expensive property you can finance. It's in living in a place that doesn't steal your peace or your future. And that's how Buffett thinks. Not about the size of the house, but about the space left in the budget after it's paid for. Wealth is having control over your money. When you avoid a new car, you're not depriving yourself. You're buying future freedom. Freedom to invest, freedom to sleep peacefully, freedom to not depend on the next paycheck to breathe. And that's how wealth building begins. Not with big bets, but with simple decisions repeated over time. Here's a silent trap that seems normal, but corrodes wealth from within. Paying interest on something that loses value. When you finance an asset that depreciates, something dangerous happens. The object is worth less and less, while the debt continues to exist, firm, charging interest month after month. It's like running on a treadmill. You make an effort, pay, work, but don't go anywhere. Warren Buffett has always warned about this. Debt is not an enemy when used intelligently, but it becomes destructive when applied to things that don't generate returns. Financing an asset that doesn't produce income means trading your future for immediate comfort. Buffett teaches that debt should be used with extreme caution, only when there is a real expectation of return. Otherwise, they transform into invisible chains, limiting choices and delaying the construction of financial freedom. Those who understand this learn to wait, plan, and buy only when it makes sense. And this patience separates those who build wealth from those who are always paying bills. Many bad financial decisions are not born from necessity, but from comparison. Buying something just to show off, to prove worth, or to not seem lesser is one of the fastest paths to financial strain. Buffett never worried about looking rich. He worried about being free. While many people spend trying to impress people they barely know, he chose to invest in silence. The problem with status spending is that it never ends. There will always be someone with something better, more expensive, or newer, and those who enter this game end up working not for themselves, but to sustain an image. Buffett teaches that social approval doesn't pay bills, doesn't guarantee peace of mind, and doesn't build a future. Financial freedom does. When you stop spending to impress, money is left over, clarity is left over, and decision-making power is left over. Buying too much is easy. Buying well requires awareness. Buffett has always valued the idea of acquiring only what really makes sense. Buying less, but with quality, reduces waste, avoids constant replacements, and creates solid financial habits. Each unnecessary purchase is money that stops working for you. A conscious purchase lasts longer, generates fewer future expenses, and frees up resources for investments. This advice is not about living poorly or giving up comfort, it's about choosing better. Those who learn to buy with intention spend less without feeling loss, and this difference makes all the difference in the long run. Changing phones or computers just because a new model came out seems harmless, but in the long run it's expensive. Buffett believes that technology should serve productivity, not ego. If something still works well and meets your needs, changing it for fashion is a waste of money and focus. The sum of these constant small changes consumes resources that could be being invested. And wealth is not built with impulsive changes, but with rational decisions repeated over time. Those who use technology to the end learn to extract maximum value from what they already have, and this is a fundamental principle of good financial management. Saving without investing is like storing seeds and never planting. Buffett makes this very clear. All money saved by avoiding excesses must have a destination, and that destination is investment. This is where the magic of compound interest begins to act. Small amounts invested consistently grow over time, creating a powerful effect. It's not about large contributions, but about regularity and patience. Those who invest the difference transform simple present choices into big future results. This is one of the central pillars of Buffett's philosophy. There's the idea that happiness needs to be expensive. Buffett never believed that. Luxury trips, excessive spending, and expensive experiences don't guarantee lasting satisfaction. Many times, they only create bigger bills afterward. Buffett has always valued affordable, simple, and financially sustainable experiences. Pleasant moments don't need to compromise the future to be good. When you understand this, you begin to enjoy life without guilt and without destroying your financial stability. And this balance is one of the secrets to a prosperous and peaceful life. This is one of Warren Buffett's most powerful pieces of advice. It doesn't matter how much you earn. If you spend everything that comes in, you'll always depend on the next paycheck. Living below what you can allows you to create margin, security, and opportunities. Buffett built his wealth maintaining a simple standard of living even when his income grew a lot. He knew that each dollar not spent was a dollar that could be invested. This difference between earning and spending is where wealth is born. Those who understand this are never hostage to their own standard of living. Finally, the principle that connects all the others. Buffett never made decisions thinking about the next month. He thought 10, 20, 30 years ahead. This long-term thinking changes everything. Before spending, he evaluates, does this help or hinder my future life? Before investing, he thinks of time as an ally. Those who think in decades build something solid. Those who think only in months live putting out fires. True wealth is not born from haste, but from constancy. And Buffett proved this throughout his entire life. Many people believe that earning well means being financially secure. Warren Buffett has always warned that this is a dangerous mistake. High income only shows how much money comes in. Wealth shows how much money remains and grows over time. There are people who earn a lot and live in debt, pressured, trapped in a standard of living that demands more and more. At the same time, there are people with common income who build solid wealth because they know how to control expenses, invest, and think long-term. Buffett teaches that what changes life is not how much you earn today, but what you do with what you earn. When income increases and expenses rise in the same proportion, progress is zero. True wealth is born when you transform part of your income into assets that work for you, month after month, year after year. Without this, high income becomes just an illusion of security. One of the biggest financial mistakes is wanting quick results. Warren Buffett built his fortune based on a simple but powerful word: patience. Many people start investing expecting immediate changes. When they don't happen, frustration arises, decisions become impulsive, and mistakes appear. Buffett has always taught that wealth is built like a tree. First you plant, then you care for it, and only much later do you harvest. Financial growth happens silently. For years it seems like nothing is happening, but it's exactly during this period that compound interest is working. Those who give up early don't see the result. Buffett often says that the market transfers money from the impatient to the patient. Those who understand this stop chasing shortcuts and begin to trust the process. Patience protects you from emotional decisions, from fads, and from easy promises. And in the long run, it becomes one of the greatest allies of prosperity. Warren Buffett never invested in something he didn't understand. This simple principle avoided enormous losses throughout his life and helped build solid and consistent wealth. Many people put money into investments just because someone recommended it, because it's fashionable, or because they heard promises of quick gains. The problem is that when something goes wrong, they don't know the reason, panic, and make bad decisions. Buffett teaches that investing without understanding is like driving with your eyes closed. You might even move for a while, but the risk of an accident is high. When you understand where you're putting your money, you gain confidence. You know why you invested, you know what to expect, and you know when to stay calm. This reduces emotional errors and increases your chances of long-term success. Investing well is not about knowing everything. It's about knowing enough to not act in the dark. Many people focus only on making more money, but forget something fundamental: protecting what they've already achieved. Warren Buffett has always made it clear that the first principle of finance is not to lose money, and the second principle is never to forget the first. Before thinking about high returns, you need to ensure that the money is safe. Large losses require even larger gains to be recovered. When someone loses 50% of their capital, they need to gain 100% just to get back to the starting point. This consumes time, energy, and generates impulsive decisions. Buffett understands that financial growth should be constant, not risky. He prefers slow and safe advances to quick gains that can disappear from one moment to the next. That's why he always avoided investments that promise high returns, without clearly explaining the risks involved. Protecting money means diversifying, understanding risks, avoiding concentrated bets, and not putting everything into something you don't master. It also means having reserves, safety margins, and discipline to not act on emotion. Those who learn to preserve capital gain something even more valuable: peace of mind to continue investing. Protection allows time to work in your favor. Without it, any mistake can put everything at risk. Buffett built his fortune not by taking extreme risks, but by avoiding unnecessary losses. And this mentality is what keeps wealth alive for decades. Warren Buffett has always valued the concept of margin of safety, not only in investments, but in financial life as a whole. This principle means never operating at the limit, never spending everything, never depending on a single scenario for everything to work out. When a person lives at the budget limit, any unexpected event becomes a serious problem. An unexpected expense, a drop in income, or an opportunity that arises end up generating stress, debts, or hasty decisions. Those who maintain a margin can breathe, think, and choose better. Buffett believes that financial security doesn't come from predicting the future, but from being prepared for it. Having reserves, spending less than you earn, and maintaining space in the budget creates silent protection against crises and mistakes. This margin also allows you to seize opportunities when they appear. Good investments usually emerge in difficult times, but only those who have liquidity can act. Those who are tight only watch. Creating a margin of safety is not about fear, it's about intelligence. It's accepting that unexpected events are part of life, and that the best defense is to always be one step ahead. This simple habit transforms anxiety into confidence and fragility into stability. And over time, it becomes one of the strongest pillars of wealth building. Warren Buffett has always made it clear that investing well doesn't depend on being a genius, but on knowing how to control your own emotions. Many people even understand finance, know numbers and strategies, but lose money because they can't stay calm. When fear appears, they sell at the wrong time. When euphoria arises, they buy without thinking. This emotional back and forth destroys results that would take years to build. Buffett teaches that the investor's biggest enemy is not the market, but themselves. Those who react to every news item, every fluctuation, or every outside opinion end up making impulsive decisions. Emotional control allows you to act with logic, even when the environment is confused. It allows you to maintain solid investments during difficult times and avoids entering fads just because of external pressure. Over time, those who master emotions create an enormous advantage. Not because they know more, but because they make fewer mistakes. And in finance, avoiding big mistakes is as important as seeking good successes. Warren Buffett has always chosen the simplest path when it comes to money. While many people complicate their own financial life with dozens of accounts, scattered debts, and investments they don't understand, he followed the principle of clarity. Simple finances are easier to control, monitor, and adjust. When everything is clear, mistakes become visible quickly. When it's confusing, problems grow hidden. Buffett believes that simplicity reduces costs, reduces stress, and reduces bad decisions. Having few well-understood investments is better than having many that you can't follow. Having fewer organized debts is better than several small obligations that drain mental energy. Simplicity also helps maintain discipline. The fewer financial distractions, the easier it is to follow a long-term plan. Those who complicate too much end up getting tired and giving up. In the end, wealth is not complexity. It's clarity, consistency, and time. And simplicity transforms all of this into something sustainable for many years. Warren Buffett never built his wealth betting on luck. He always followed method, repetition, and discipline. While many people seek the right move or the perfect opportunity, Buffett built results by doing the basics well every day. Trusting luck is leaving the future in the hands of chance. Trusting method is taking control. A financial method means having clear rules: when to spend, when to invest, when not to act, and when to wait. Buffett understands that good results don't come from isolated decisions, but from the sum of correct choices made consistently. Even simple decisions, when repeated over years, produce extraordinary results. Those who follow method don't despair in bad times or get too excited in good ones. They continue doing what has always worked. This constancy creates stability and growth. In the long run, discipline beats talent, patience beats haste, and method beats luck. And that's how wealth stops being a chance and becomes a consequence. Many people believe they will get rich trying to guess the best time to enter or exit an investment. Warren Buffett has always been against this idea. For him, trying to predict the market is a waste of time and a constant source of errors. The market goes up and down, sometimes without apparent reason. Those who try to anticipate every movement end up buying late and selling early, exactly the opposite of what they should do. This behavior generates anxiety, impulsive decisions, and avoidable losses. Buffett teaches that time in the market is more important than timing the market. Investing regularly, maintaining good assets, and letting time work produces much more consistent results than attempts at guessing. When you stop trying to time it right, you start to focus on what really matters: quality of investments, discipline, and patience. This reduces stress and increases the chances of success. Wealth is not built by predicting the future, but by remaining firm during the journey. Buffett did this for decades, and this is one of the reasons for his extraordinary results. Looking at all these pieces of advice together, it's clear that Warren Buffett never built wealth trying to look smart, impress people, or seek shortcuts. He built wealth doing the basics very well, repeatedly, for decades. Nothing here depends on luck. Nothing requires extraordinary earnings. Everything depends on simple choices, discipline, and time. Avoiding unnecessary expenses, living below standard, investing consistently, protecting capital, and thinking long-term are not exciting decisions. But these are exactly the silent decisions that build true financial freedom. Buffett teaches us that money is not meant to show power, but to buy peace of mind. Peace of mind to choose how to live, where to work, when to stop, and how to help those you love. Those who understand this stop chasing appearance and begin to build something solid. They begin to trade immediate pleasure for future security, and without realizing it, they enter a path where money stops being a problem and becomes a tool. If this content made sense to you and helped you see money in a different way, like the video and subscribe to the channel to continue receiving clear, practical, and applicable teachings about wealth, mindset, and financial freedom. Now tell me, which of these pieces of advice most changed the way you see money today?